What do you get when a company that's been around for over 120 years decides to completely reinvent itself?
If it's 3M, you get one of the most fascinating turnaround stories in the S&P 500 right now.
Welcome to Charged Alpha. I'm Hudson Thomas, and today we're diving deep into 3M Company, ticker MMM. Lana, this is not your grandfather's tape and sandpaper company anymore.
Not even close. They spun off their entire healthcare business, brought in a new CEO from the defense world, and now they're betting on AI data center technology.
A 124-year-old conglomerate pivoting to fiber optics. We've got a lot to unpack. Let's start with the origin story because it's great. 3M was founded in 1902 in Two Harbors, Minnesota, originally called Minnesota Mining and Manufacturing. 5 entrepreneurs started the company to mine corundum for abrasives.
And here's the twist. The mineral they found wasn't even corundum. The company nearly went bankrupt before it got off the ground.
A St. Paul businessman named Lucius Ordway rescued them in 1907. And then a guy named William McKnight joined as an assistant bookkeeper, making $11.55 a week. He went on to run the company for decades.
McKnight is the one who invented the famous 15% rule in 1948, letting engineers spend 15% of their time on their own projects. Google's 20% time is a direct descendant of that idea.
So today, post-Solventum spinoff, 3M operates in 3 segments. Safety and industrial is the biggest at about $11.5 billion in revenue. That's roughly 46% of the company. Think abrasives, adhesives, personal safety equipment.
Transportation and electronics comes in at $8.3 billion, about a third of revenue. This is where the growth story lives. Automotive, electronics, and the optical interconnect technology for AI data centers.
And then consumer at about $5 billion, the brands everyone knows. Post-it notes, Scotch tape, command strips, Scotch-Brite. All told, they make over 60,000 products.
What matters about the post-spinoff 3M is the portfolio focus. They shed the healthcare drag, and now they're a pure-play industrial materials and technology company. Headquartered in St. Paul, about 61,500 employees.
The moat is real, too. Over 100,000 active patents, brands with incredibly high switching costs, and they spend 6% of revenue on R&D, which delivers 57% greater returns on research capital than their peer average. The man steering this ship is Bill Brown, William Brown officially, who took over as chairman and CEO in May 2024. Villanova mechanical engineering grad, Wharton MBA, and he came straight from the defense world.
He ran Harris Corporation and then L3 Harris Technologies after the merger. Execution-focused operator, Jim Cramer has called him one of his favorite industrial CEOs.
What's his reputation like beyond the Cramer endorsement?
He gets credit for stabilizing 3M after the Solventum spinoff through what the company calls operational rigor. Fair criticism from his L3 Harris days, though. Some said he prioritized shareholder returns over employee satisfaction. 2 years in, the market seems to like what he's doing here. All right, let's dig into the financials. 3M trades at about $152.55, giving it an $80 billion market cap.
How does the valuation look?
Trailing PE is 25 times, forward PE around 20 times, price to sales at 3.2. That's elevated relative to 3M's own history, but not unreasonable for a company in turnaround mode with accelerating growth.
What about the top line?
Trailing 12-month revenue comes in around $25 billion. The quarterly trend tells a story. Q1 2025 was the low point at $5.95 billion. Then they ramped to $6.5 in Q3 before settling at $6.1 Q4. Lumpy, but trending the right direction. Gross margins at 39.5%, operating margins at about 19%. Earnings per share trailing 12 months is $6.07.
And the balance sheet?
Cash of $5.9 billion against total debt of $13.5 billion. That's a meaningful debt load, about 2.7 times debt to equity. Operating cash flow around $5.3 billion, free cash flow approximately $4.6 billion.
So they can service the debt comfortably.
Absolutely. The free cash flow gives them room to invest in growth, service debt, and pay that 2.2% dividend yield. Overall, 3M's financial health is solid. The turnaround is generating real cash flow improvement, but the elevated debt and above-average valuation deserve monitoring.
What are the analysts saying about this one?
17 analysts cover 3M, and the consensus is moderate buy. 11 buys, 4 holds, 1 sell. Average price target is $169.50, about 11% upside from current levels. The range goes from 136 on the low end to 190 at the top.
Any standout calls?
Barclays raised their target to 180, citing strong momentum from new product initiatives. Morgan Stanley upgraded from underweight to equal weight with a 160 target. That's a meaningful sentiment shift for a stock they were bearish on.
What about the cautious voices?
RBC acknowledged the Q3 operating beat, but flagged PFAS litigation as an underappreciated risk. On the earnings front, Q4 2025 they beat on both revenue and EPS and guided for 3% organic sales growth with 7.5% EPS expansion. Next earnings date is April 28th.
Let me lay out the bull case. Number 1, the AI infrastructure angle is massive. 3M's expanded beam optical interconnect technology is getting a U.S. manufacturing expansion specifically for AI data center demand. This is a company most people think of as tape and post-its, suddenly becoming a picks and shovels play in the AI build-out.
That's compelling. What's catalyst number 2?
Product innovation is accelerating fast. They launched 284 new products in 2025, a 68% increase year over year, and they're targeting 350 for 2026. Products launched in the last 5 years grew 23%. And then there's margin expansion, 70 to 80 basis points expected as manufacturing investments mature. Plus, organic growth accelerating from 2.1 to 3%.
Now the bear case. First, PFAS litigation. This is multi-billion-dollar exposure that remains a material cash flow and balance sheet risk. Settlements are ongoing and regulatory scrutiny continues to intensify.
That's the big one.
Second, margin compression could bite in 2026 as they ramp CapEx for EBO technology and Solventum transitional service agreements expire. Third, their AI data center business is concentrated among a small number of hyperscaler customers. That's revenue volatility risk. And fourth, 3% organic growth is modest. If the macro deteriorates, that number could turn negative.
How does 3M stack up against the competition?
Against Honeywell, 3M trades at a similar PE, 25 versus 21 for Honeywell, but Honeywell is growing revenue nearly 4 times faster at 7.8%. Their aerospace and automation exposure provides structural growth tailwinds.
And Danaher?
Danaher trades at a significant premium, 42 times earnings, but it has the best growth profile with life sciences and diagnostics exposure. Johnson & Johnson is the defensive comparison. Lower beta, premium valuation, less industrial cyclicality. Among this peer set, 3M has the cheapest price to sales at 3.2 versus nearly 4 for Honeywell and 5.8 for Danaher.
What's the options market pricing in?
Put-call ratio sits at about 0.85, slightly bullish. Implied volatility percentile around 38, so nothing dramatic. The interesting data is where open interest clusters,
Which is where?
call side activity concentrates in the 160 to 180 range, lines up with analyst targets. Put side clustering around 145 to 155 suggests that's where the market sees support. The options market isn't pricing in any dramatic move ahead of April earnings.
What about insider transactions?
This is a yellow flag. Over the past 12 months, 4 insider buys versus 7 sells, with net sales of roughly $8 million. The standout was EVP Mark Murphy selling about $3.2 million in October 2025.
So more selling than buying.
Minimal buying from Group President Christian Goralski. Insider selling outweighing buying isn't unusual at this executive compensation level, but the ratio isn't exactly a ringing endorsement of the turnaround thesis.
What should investors be watching going forward?
The April 28th earnings report is the next big catalyst. Watch the organic growth rate. Does 3% hold, or do they raise? EBO technology revenue. Any color on data center customer wins would be meaningful.
What about on the risk side?
PFAS litigation updates. Any new settlements or regulatory actions. And margin trajectory. Are they tracking toward that 70 to 80 basis point expansion? If organic growth comes in above 3% and management signals EBO demand acceleration, this stock could re-rate meaningfully to the upside.
So what's the bottom line on 3M?
3M is a 124-year-old company trying to write its next chapter. The turnaround under Bill Brown is real. Innovation is accelerating, AI infrastructure exposure is timely, and cash flow generation is strong. But the valuation already reflects meaningful optimism. Insider selling is a cautionary signal, and PFAS litigation remains the wild card. The single metric I'd watch is organic growth rate. If it accelerates past 3%, the bull case gets much more compelling.
A company with 100,000 patents and 60,000 products, betting its future on fiber optics for AI. That's 3M in 2026. I want to close with a quote that feels right for this one. Albert Szent-Györgyi once said, "Innovation is seeing what everybody has seen and thinking what nobody has thought."
That pretty much captures 3M's entire 100-year playbook.
From sandpaper to post-it notes to AI data center interconnects, that's a through line worth paying attention to. That's going to do it for episode 139 of Charged Alpha, our deep dive into 3M Company, ticker MMM. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.